Imagine waking up to a stock market in chaos, prices plummeting, investors panicking, and headlines screaming, bloodbath. What's really causing this turmoil? Is it inflation, geopolitical tensions, or something deeper? And more importantly, how can you not just survive but thrive in these turbulent times?
All right, so let's jump into a topic that I bet a lot of you listeners think about, and that's stock market turmoil and all that kind of volatility.
Yeah.
It can feel like a roller coaster ride. You know, one minute you're up and the next minute you're down.
Yeah, definitely.
And today we are going to go deep and try to understand what causes those drops, and even more importantly, what can you actually do when the market goes haywire?
Yeah.
So our guide for this deep dive it's got some really good advice for investors.
Excellent. Yeah, it's a really common misconception that market downturns are only caused by like a single event.
Yeah.
In reality, it's more like a domino effect with multiple factors knocking into each other and kind of creating this downward spiral.
Domino effect. That's a good analogy, and I like that. So what would you say is the first domino? Is it economic uncertainty? Because, everyone's talking about recession fears and inflation these days.
Yeah, those are definitely big factors.
Yeah.
And then you throw in rising interest rates, which can affect both businesses and consumers. You've got a recipe for anxiety in the markets.
Yeah, for sure, for sure.
And it's not just that these things exist in isolation.
Right.
It's how they interact and feed off each other.
Oh, right, okay. Yeah, so walk me through that. How do these economic factors, connect to each other and cause this chain reaction?
Okay, so let's say, for example, inflation is super high, like it has been recently.
Yeah.
And then central banks, they aggressively hike interest rates to cool things down. But then those higher rates, they make it more expensive for businesses to borrow money, which could potentially slow down their growth and even lead to job losses.
Oh, wow. Yeah.
And then suddenly those whispers about a recession start to get a lot louder.
Yeah, and then that makes investors nervous, right?
Yeah,
And they
nervous
start
and-
selling off their stocks, which further drives prices down, and then it just creates this cycle of fear.
Precisely. And that brings us to another big factor in market turmoil, and that's market sentiment.
Okay.
Fear is contagious.
Oh, yeah.
When people see headlines about a looming recession or a big company taking a hit,
Yeah.
they often react emotionally, and that leads to this panic selling.
So it's kind of like a self-fulfilling prophecy.
Yeah.
The fear itself becomes a driving force in the downturn.
In many cases, yeah.
Wow. That's kind of scary.
And this fear is amplified if the market was overvalued to begin with.
Okay.
Think of it like a bubble. Prices get inflated beyond what's justified by the underlying value of companies.
I mean, right.
Eventually, that bubble bursts.
Pops.
Yeah.
That's what we want to try to avoid, or at least know how to handle.
Exactly.
Our source pasted text also talks about global events as a trigger for market turmoil. And I imagine the pandemic is probably a prime example of this.
Absolutely. The pandemic was like a textbook example of what they call a black swan event.
Yeah.
Something totally unexpected that just
Okay.
sends shockwaves through the global economy. And we saw similar reactions with other major events like natural disasters or even like big supply chain disruptions.
It's like a ripple effect, it feels like almost.
Yeah. Yeah, exactly.
Okay, so it doesn't always have to be something huge and global, though, right?
Right.
Sometimes trouble starts brewing in a specific sector.
Absolutely. So imagine a new regulation
Okay.
that really impacts a certain industry
Uh-huh.
or a new, groundbreaking technology that totally disrupts the status quo.
Okay.
Think about what happened to traditional retail when online shopping became a big thing.
Yeah.
Those kind of shifts can really send specific sectors into a tailspin.
Okay, so we've got a pretty good picture now of all the different dominoes that can set off a market downturn. Economic jitters, panicky investors, global shocks, and even those sector-specific shakeups.
Yeah.
But let's get to the part that I'm really interested in. What do we actually do when the market starts to freefall?
Right.
Pasted text calls this section like a survival guide. Is that a good way to think about it?
Yeah, I think that's a really good way to put it.
Okay.
The first rule of survival, don't panic. One of the worst things you can possibly do is just succumb to the fear and start selling off your investments just because everyone else is.
Right, but that's easier said than done, though, right?
Oh, definitely.
I mean, when you see your portfolio plummeting,
Yeah.
it's natural to want to just cut your losses, but you're saying that's the worst possible move.
Historically, markets have always recovered from downturns, even from the really bad ones. And by selling at the bottom, you're locking in your losses, and you miss out on that eventual rebound.
Okay, so patience is key.
Absolutely.
Our source also says we should avoid trying to time the market. What exactly does that mean, and why is it a bad idea?
So timing the market means trying to predict exactly when to buy low and sell high. And it sounds great in theory,
Right.
but in reality, it is so difficult to do consistently.
Oh, wow.
Even seasoned professionals, they struggle to predict the markets every twist and turn. You might get lucky once or twice, but over the long term, it's usually a recipe for disappointment.
Okay, so no panic selling and no trying to be a market psychic. So what should we be doing when things get rough?
Okay, so the strategies in pasted text are all about staying calm, keeping your eye on the long game, and making decisions that align with your overall investment goals.
Okay.
And the first piece of advice is a classic. Diversify your portfolio.
Don't put all your eggs in one basket.
Exactly.
Yeah.
But I'm guessing there's more to it than that.
Yeah, there is, for sure. So think about it like this. If you invest all of your money in just one subtle stock or a single sector, and that stock or sector takes a hit, your entire portfolio suffers.
Right.
But if your investments are spread across different asset classes, stocks, bonds, real estate, maybe even some commodities, the impact of any one investment doing poorly is much smaller.
So it's almost like a safety net for your investments.
Exactly.
So even if one part of the market is struggling, other parts might be doing okay, and that helps cushion the blow.
Exactly. And don't forget about international diversification, too.
Okay.
If one country's market is having a rough time, another country's market might be doing really well.
So by having a mix of domestic and international investments, you're reducing your risk even more.
So diversification is all about spreading your bets wisely and making sure you're not overly exposed to any one area.
That's it.
What's next on the survival guide checklist?
Okay, so next up we have to talk about quality. Especially during a downturn.
Okay.
You want to make sure you're investing in companies with strong fundamentals.
Fundamentals meaning like they're not just hype machines. We're talking about businesses that are built to last.
Exactly. Look for companies with solid balance sheets, consistent earnings, and a competitive advantage that's going to allow them to weather the storm. Think of it like building a house. You want a strong foundation.
Yeah.
Not just fancy decorations.
So how can everyday investors figure out if a company has those strong fundamentals? Does it require digging through tons of financial statements?
It can be a bit daunting, yeah, but there are resources available to help. You can find a lot of information online, including analyst reports and financial news articles that break down a company's performance.
Okay.
And of course, talking to a financial advisor can be super helpful.
Yeah, always good to have an expert in your corner.
Exactly.
Okay, so we've got diversification and we're focused on quality. What else can we do to navigate market turbulence? Our source pasted text mentions dollar cost averaging. That sounds kind of technical.
It might sound complicated, but it's a pretty straightforward strategy.
Okay.
Instead of trying to time the market and invest a big lump sum all at once, you invest a fixed amount of money at regular intervals,
Okay.
regardless of whether the market is up or down.
So if the market dips, you're buying more shares at a lower price.
Exactly.
And if the market surges, you're buying fewer shares at a higher price. It's a way to average things out.
Exactly. Dollar cost averaging takes the emotion out of investing. It's like putting your investments on autopilot, which can be especially helpful during those times of volatility.
Sounds almost too simple. Are there any downsides to dollar cost averaging?
Well, it's not a magic bullet. And there are potential drawbacks. Like if the market consistently goes up over time, you might actually earn a bit less than if you had invested a lump sum at the beginning.
Okay.
But for many investors, especially those who are risk averse or new to investing, the benefits of smoothing out that volatility really outweigh the potential downsides.
It's like a trade-off then between maximum gains and peace of mind.
Yeah, exactly.
Speaking of peace of mind, what about rebalancing our portfolios? I've heard that term, but not really sure what it means.
So rebalancing is about getting your portfolio back in alignment with your target asset allocation.
Okay.
Over time, certain investments perform better than others. And your mix of stocks, bonds, and other assets can drift.
Okay.
So rebalancing means selling some of your winners and buying more of your losers to bring your portfolio back to that desired balance.
So it's like hitting the reset button on your investments, making sure you haven't strayed too far from your original plan.
Exactly, and it's a crucial part of managing risk. Without rebalancing, your portfolio could become too concentrated in one area.
Okay.
That has performed well, which could expose you to greater losses if that asset class suddenly takes a downturn.
Makes sense. It's like pruning a garden. You're trimming back the overgrown parts to help the whole thing grow evenly and sustainably.
I like that analogy.
Now, I'm curious about this idea of defensive investments that our source pasted text mentions. Are these like the bunker of the investment world?
In a way, yes, defensive investments tend to hold up better than others during economic downturns.
Okay.
They're not as sensitive to the ups and downs of the market cycle.
So what kind of investments are we talking about here?
Think about sectors that provide essential goods and services that people always need no matter what the economy is doing.
Okay.
Things like utilities, healthcare, consumer staples.
Right.
People still need electricity, medical care, and groceries, even during a recession.
Okay, so it's about investing in things that are always in demand. Does that include bonds?
Bonds could definitely be a good defensive play.
Okay.
Especially government bonds. They tend to be less volatile than stocks
Uh-huh.
and can provide a steady stream of income even during turbulent times.
So we've covered a lot here. Diversification, focusing on quality companies, dollar cost averaging, rebalancing, and adding some defensive investments to our portfolios. Is there anything else we should be doing to weather a market storm?
One last tip, and it's maybe the simplest but most important of all, keep some cash on hand.
You mean actual cash just sitting in a savings account?
Yeah.
I thought the whole point of investing was to put your money to work, not let it sit idle.
Having some cash reserves has multiple benefits. First, it gives you peace of mind knowing you have a buffer if there's an emergency or unexpected expenses, can help you stay calm and rational when the market is going crazy.
It's like having an emergency fund for your investments. That makes sense. But is there another reason to keep some cash on the sidelines?
Absolutely. Having cash gives you flexibility. If prices drop, you can seize those buying opportunities.
Right, like those clearance sales we talked about.
Exactly. Market downturns can create some incredible deals for those who are ready to act.
That's like Warren Buffett's famous advice, right?
Right.
Be fearful when others are greedy and greedy when others are fearful.
Precisely. He understood that market downturns, while they can be unsettling, can present amazing opportunities for those who can keep a cool head and maintain that long-term perspective.
It takes discipline, though, right? To buy when everyone else is selling. Almost got to go against your instincts.
Yeah, it does. It takes a certain level of courage, too. But, if you've done your research and you really believe in those companies, and you've got a solid plan in place, those dips can actually be a chance to buy more of what you believe in at a lower price.
So it's almost like turning a negative into a positive.
Exactly. Yes, it's a mindset shift.
Okay, so we've covered a lot of ground in this deep dive. We talked about what causes market plunges and why it's so important to not freak out, and make rash decisions.
Yeah, stay calm.
Stay calm. And we also talked about a whole bunch of different strategies for navigating a downturn.
Yeah, whole toolkit.
A whole toolkit. Yeah, exactly.
And, it's worth remembering that investing is a marathon, not a sprint.
Right.
Market fluctuations are just part of the game.
Yeah, it's going to happen.
It's going to happen. It doesn't have to derail your long-term financial goals.
Before we wrap up, any final words of wisdom for our listeners as they, continue their investing journey?
Stay informed, stay disciplined, and remember that knowledge is power.
Oh, I like that.
The more you understand about how markets work and, what factors can influence them, the more confident you'll feel when you're making decisions no matter what the market's doing.
Yeah. Informed and empowered. That's the kind of investor we want our listeners to be. And speaking of empowering, it wouldn't be a true deep dive without leaving our listeners with a little something to ponder.
Absolutely. So we've talked about a lot of strategies today, but the question is, how can you apply those to your own situation? What are your specific investment goals? Your time horizon? How comfortable are you with risk?
Yeah.
Take some time to think about that, maybe even write some stuff down.
That's a great takeaway. This isn't about just blindly following someone else's advice. You got to take this information and figure out how it fits with your own investing philosophy.
That's it.
And remember, there are resources to help you. Don't be afraid to reach out to a financial advisor if you need help or just want to get a second opinion.
Absolutely. Yeah, sometimes it's good to have a pro in your corner, especially when things feel unpredictable.
Well said. Well, I think our listeners are well equipped now to handle whatever the market throws at them.
I think so too. Knowledge is power, and the well-informed investor is a confident investor.
Couldn't have said it better myself. Thanks for joining us on this deep dive, and until next time, happy investing.